Hey guys, I'm Phil Town from Rule One Investing, and today I want to debunk a couple of common myths about investing in the stock market. For a lot of people, the stock market may seem like a really complicated, abstract thing. You got no idea how it really works. And the problem is, with that uncertainty comes a lot of false information, false beliefs, bad investing. And what I want to do here is to help set the record straight so that these misconceptions won't deter you from investing or negatively impact your results from your investing strategy. So let's take a look at 5 of the most common myths about the stock market and why they are simply not true. The first one is you have to be an expert to manage money. This is nonsense. You don't even have to be that smart to manage money. Warren Buffett says, this is not a game where 160 IQ beats a guy with a lower IQ. It's just not that sort of thing. In fact, these so-called experts rarely even beat the market that's not managed by anybody. You could get the same results that you would get from putting your money with almost any fund manager out there by just putting your money in SPY, which is a simple ETF that tracks the S&P 500. You don't have to pay any fees. You don't have to pay any commissions. It's all done. And you will do at least as good as they will do over any length of time. So you don't have to be an expert to do as good as the professionals. And what's even better is you don't have to be an expert to do really well, to do much better than the professionals. You could do this part-time, a couple hours a week, and you could do extremely well if you know what you're doing. The key thing, of course, is to know what you're doing and invest like the best investors in the world, people like Warren Buffett, Charlie Munger, who have been trying to teach us how to invest for 60 years. Comes down to a real simple process. You simply be sure you're capable of understanding the business, make sure it has a big protective moat, great management, and you buy it on sale. That's the routine we follow every day in order to be able to go out and do well with our money. And you can do that too. It doesn't take expertise. Okay, second thing just comes right from the first thing. The myth is you can't beat the market. That is just completely nonsensical. It's a myth that's spread from a theory about investing called the efficient market theory that came out of academia, University of Chicago in 1960s. And it kept getting spread. It went all over the Ivy League, and it's still all over the whole MBA programs in almost every university there is in the country. And what they teach you is literally that you can't beat the market, that the market is perfectly pricing everything all the time. There couldn't be a bigger pile of nonsense. And in fact, one really good investor named Seth Klarman said that the academics continue to prove in theory what has been disproven in fact. And that is that tons of investors beat the market all the time. So don't fall for that nonsense that you can't beat the market. In fact, Prem Watsa, who's one of the best investors in Canada, he's considered the Warren Buffett of Canada, said that the worst mistake you can make is to think that this market people, these professionals, know more than you do. Not true. You can beat the market. Now, the third myth is the best way to minimize risk is to diversify your investments. That's true to a small degree, but not to the degree that they take it to as financial advisors and fund managers. They massively over-diversify. And the reason that they do that isn't to minimize your risk. It's to minimize their risk. They don't know what to buy. They are just salespeople. They're going out and buying whatever their departments and their investment departments tell them to buy. They have no idea whether it's good or bad. And the best way to minimize their risk is to have you diversify across everything. And that way, they'll probably do around what the market's doing. And that's good enough for most people because most people don't know what they're doing in the market. The best way to minimize risk is to know what you're buying. Now, come on. If you're going to go to a garage sale, the best way to minimize risk is what? Buy everything at the garage sale? That would be diversification. No, it's stupid. The best way to minimize risk going to a garage sale is to simply only buy the things you understand. If you see a Bowflex machine and you know how to fix it and you could buy it for $10, what risk do you have? You can fix it up, sell it on eBay for $200, right? In fact, one of our students does that with mink coats. So no, Risk is about not knowing what you're doing, and that's exactly what you're doing when you don't know how to invest. The fourth myth is that investing in the stock market is just like gambling. It is absolutely not at all like gambling. Gambling is a process of going out and speculating in the hopes that something good happens, typically against the odds of it happening. Okay, that would be gambling. Now imagine if you're a so-called investor and you go to Las Vegas and you don't intend to speculate, you don't intend to gamble. Could you get into a game where you weren't really gambling? And the answer is yes, you could actually. You could count cards in blackjack. And if you're willing to play long enough and you're a good card counter, you're no longer gambling. You are going to beat the house. The odds have shifted in your favor. Investing is like that. Investing is the process of being certain that you understand the business, that it is protected by a big moat and therefore is going to be bigger in 10 years than it is today, that it has management that isn't going to turn on you and be a traitor, that they share your values and they want to do good for the same exact reasons you do. That management team has integrity and talent, hopefully. And then finally, you understand the value of this business and you buy it when it has a deep discount. We call that a margin of safety. If you buy businesses with a big margin of safety, essentially it's like buying a $10 bill for $5. Are you gambling because somebody will sell you a $10 bill for $5? I don't think so. I don't think so at all. And that's what we're trying to do. We want to go out and buy companies at a 50% discount to what they're worth, just like buying a $10 bill for $5. And then by and large, we end up with a really good return on those investments. So stock market investing is investing, and that means going out with an asset where you're certain to make money, or as certain as you can possibly be in this world. All right, the fifth myth that I want to bust is that stock market crashes are bad for investors. Man, everybody thinks so, right? Because they're all investing in a big diversified portfolio, and lo and behold, they have no protection, no matter how diversified they are, virtually no protection against the stock market crashing. All of their investments go down like a brick. This is because they're not investing. They're simply speculating in the idea that the stock market always goes up. It doesn't always go up. And we want it to crash because as good investors, we're waiting patiently for a big economic storm. And when that storm comes in, you guys, it's going to rain gold for a little while. Might rain gold for 3 days, it might rain gold for 3 weeks, but it is going to rain gold in the form of wonderful businesses that we have been studying and we understand them and we know what they're worth. And when they go on sale, we are going to load up the truck. So stock market crashes, far from being bad for investors, are an opportunity for us to invest with near certainty that we're going to get a great rate of return. In fact, the last time we had a major market crash that lasted, right, our big crash was 2008 and 9. I went on CNBC and said, get into this market at this time. In one of our classes, man, those guys got into it June 2009 on 10 companies that we found in class. And had they stayed in those investments, I didn't follow them, so I don't know if they did, but if they stayed in them for the next 10 years and just sat there and looked at those investments, they would have turned $100,000 into $1.2 million. Stock market crashes aren't bad for investors. They're perfect for investors. So now I'd love to hear from you guys. Did you believe any of these myths before this video? Leave a comment below with your answer and I'll be sure to follow up with you. Now, thanks for watching. Time to go play. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about the myths of investing in the stock market, just hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. Thanks again for watching.